Quantitative easing 3 is really about the Fed expanding its balance sheet once again. After several months of constant balance sheet, the Fed is trying to reflate again the system. The way they've decided to do this, they're targeting mortgages. So monthly, they've said they're going to expand at a rate of 40 billion purchases of mortgage assets in the market. They've also gave additional guidance as to how low rates will remain in terms of a time horizon. So prior it was 2014, they've stepped that out to 2015. And importantly, and I think this is what was surprising to the market, they haven't given it a size amount to the number of assets that they're going to buy. In fact, it's conditional. And I think the Fed always likes to have their options as to what they want to do with their balance sheet. But the mere fact that it's open-ended means that it could be quite significant unless things get better. So our expectations, and I think what the market has taken from it is this is really a reflation trade. This isn't about addressing a crisis, which was QE1. This isn't about addressing deflation, which was QE2. This is about reflating. And in a reflation world, you have to concern yourself when the Fed starts to expand its balance sheet about inflation. And what we saw in the market, and what we agree with, is inflation expectations have changed dramatically just in the last week relative to where the market was pricing. Will rates go higher? I think that there's a lot to warrant a posture about higher rates. I don't want to ignore the fact that there are still risks out there. And the election is a big risk. Europe still remains a risk to us. But if I had to say what's the change in expectations, it's coming through on the inflation side.
And just to put some context on the mortgage buying program, that $40 billion a month that's open-ended, that's 75% of the net supply of mortgages per month. And that number, it's not 100%, but not all mortgages originated actually hit the investor community. So that buying program is very large, and it is designed to remove agency mortgages from our toolbox of investment opportunities. So it really pushes all asset managers out into buying riskier assets. So really, it seems that that's what they've been trying to do in this context.
Thinking about the housing market, and this is something that's been a very consistent view of ours, it's distressed. In order for the distress to abate, there are some necessary preconditions, and one of them was house prices. House prices have certainly corrected nationally for sure, and regionally have done a lot of work. So hardly a constraint left on the home price side. In terms of the demand side, I think we've had years of very little construction. And years of very little construction with a population that continues to grow, ultimately you're going to absorb the overbuilding that happens. And again, housing itself is a regional market, not a national market, and a lot of what I'm telling you is all national based. There are certainly pockets in the U.S. that continue to feel the pressure of a housing market that just got over its skis, let's say. That's not necessarily nationally. And so when we think about our forecast for housing going forward, I think a lot of the preconditions that we felt were necessary have occurred. So a year ago, we were telling people, we're getting closer to the bottom of this. And I think it's important to recognize that housing, when it's not going down, it doesn't mean that it's going to go up. And the fact that it's not going down is a positive. It's a positive in terms of growth, year-over-year growth, but it's also positive in terms of investor expectations or homeowner expectations. And I think what we're seeing in the market now is a recognition by homeowners and investors that indeed we have crossed the Rubicon in terms of putting together fundamentals that allow the housing market to grow. Will it grow from this point forward? We think the conditions have gotten to the point where it can, and you're seeing it in certain markets.
In general, residential mortgages have been a very significant portion of our portfolios in the recent years. And so we spend a large amount of time analyzing distressed versus non-distressed housing. And so from a distressed standpoint, and this is something that we've been talking about for almost a year now, that distressed housing is in much stronger footing than it was previously. There's been a large amount of fundraising into programs that we call buy-to-rent programs, where simply you buy a house and you rent it out and you can get net rental yields that are between 8 and 15% net. That's a very attractive asset class that has some inflation protection in the markets. And what that has done is that it's given hope that some of these markets are in much better footing. For example, and it's one that we've used in the past, Phoenix is up 25% since December 1st of last year as a regional market. And so we have pockets of these types of situations in the U.S. that are doing very well. California is another example. We have others that are not doing so well. Florida has strong pockets, that's some zip code, and it has other pockets, just simply bad neighborhoods where there's a lot of supply and the houses are not very good shape. We at Putnam do a lot of work at the zip code level to understand these very micro-regional markets, and that helps us a lot in our valuation of residential mortgages. And at the same time, we do the same for non-distressed housing. Non-distressed housing helps for another component of our portfolios, which is prepayment strategies. Prepayment strategies have the opposite exposure to the mortgage credit side, in which case benefit if housing is stable or if housing comes down a small amount. So the same analysis that we do at the zip code level for the distressed housing, we do at the non-distressed level.